this is Richard Pearce from FinextraTV. Delighted this morning to be joined by Stephanie Vaughan. Stephanie is the Global Legal Practices Director from iManage RAVN. Good morning.
Hello, good morning. How are you?
Very good. Thanks for joining us today. We're talking about LIBOR. Given the deadline for transition away from LIBOR at the end of this year, and it's just this month, the FCA put out a press release on the same. Can you set the scene for us and explain where we are with LIBOR and this, and it's been a turbulent year. So what's the state of the market at the moment?
That's a really good question, Richard. And I think just to put the question in context, I think it's helpful to just look back briefly. So LIBOR as a rate was prevalent in a large number of financial transactions, from corporate borrowing to the bond market, derivatives market, the loan market. And crucially, it wasn't only in transactions with the UK nexus, but it applied more broadly. So for example, you also had like the USD LIBOR rates. So approximately 2 years ago, due to a number of issues, the FCA decided it would be prudent to end LIBOR. And so financial firms knew that they had until the end of 2021 to switch from LIBOR to their relevant risk-free rate. Now, as one can imagine, this transition is easier for brand new transactions, but the main questions were always around what to do with legacy transactions. So most of the context of what you're hearing around LIBOR is about what to do with legacy transactions. And you mentioned it was a turbulent year. And so back when the regulators proclaimed that the end of 2021 would be the end of LIBOR, the words pandemic, coronavirus, and lockdown were not embedded in our daily lives at all. But even though you said, this has been a turbulent year, in some industries, the industries have managed to power on in order to look at LIBOR and how they can transition to their relevant risk-free rate. And so they started to look at this problem quite early on. So if we look at ISDA, the International Swaps and Derivatives Association, and that's a trade body that's responsible for derivatives, the approach that they took in relation to legacy transactions was to put in place an industry protocol. And with the protocol, participants could adhere to that. So once both parties signed up, it would amend their legacy transactions. And the good thing about this protocol is that it actually went live a few weeks ago. And so one could say that derivatives industry has a workable solution for the LIBOR transition. Now, of course, financial products and industries aren't all very nice and neat. And so financial products don't tend to always operate independently of each other. And so the situation is really more complex where you have a hedging derivative transaction where it's linked to a loan. So the derivative is used to hedge the loan exposure. And in these circumstances, the borrower who has the loan and the swap wants to make sure that the two positions remained aligned. And so until the borrower is actually ready and able to amend the loan, they're unlikely to amend the derivative. And so that still poses quite a big challenge.
Gotcha. So are all financial institutions, and I think you've implied it in your answer, really, are they prepared for this transition? And which firms are struggling the most to finalize?
And when I think about that question, I think what's interesting is you look at it from two different lenses. So one is to look at financial institutions as a whole. And if we look at it through that lens, we can see that the larger financial institutions who actually have the largest amount of exposure knew that they had to do this, right? So they started the process a lot earlier because, quite frankly, they had to. But they also have like a large legal operations functions, a large collateral operations functions, and they generally have the infrastructure and the resources within their firm in order to look at this transition. So they started it a lot earlier, and some would say that they're very much there. However, if we look at the smaller firms who perhaps still have a comparatively fairly large exposure, they don't necessarily have the resources, but then again, they don't have the fairly large exposures that the large financial institutions have. But I would say that it is very much top of mind for every single financial institution. But if we look at it through a different lens, and this is where it gets a little bit interesting, is if you look at the different functions within those financial institutions, and it goes back to the industries that those functions predominantly serve. So if your large financial institution has a large corporate trustee function, for instance, then we can see that they actually have a harder time. And it's because of the product that they deal with. And that's because they need to go through perhaps a large consent solicitation process, which, as the name suggests, requires them to get consent from a lot of different note holders. So you can imagine that that process hasn't necessarily been as smooth when compared to other industries where you just need to look at perhaps a protocol that you're signing up to. But as I said, it's very much top of everyone's mind and no one is being complacent.
Yeah, I can imagine. So the Bank of England and the FCA have set out clear expectations for regulated firms to remove their reliance on LIBOR in new business and legacy contracts where feasible. What regulatory hurdles are there still left to jump over, and what do you predict will be some of the challenges in the year ahead?
Yeah, so I think the main challenge that's going to come up in the year ahead is what's known as tough legacy transactions. And so I mentioned that ISDA has an approach to deal with standard derivative transactions, but tough legacy transactions are a pool of existing transactions that currently reference LIBOR but are very, very difficult to amend. And examples that I've already noted, in addition to the I noted the example where you have a derivative that's linked to a loan and where you have bonds that have consent solicitation processes, and then you have much, much more complex financial transactions. And there are many different types of examples of these types of contracts where everything is intertwined. And so it's very, very difficult to make a one-size-fits-all process in order to amend these legacy transactions. And so what the industry has been doing is that they've formed a body in order to lobby the regulators in order to make legislation to deal with these types of transactions. But as you can imagine, there's a lot of uncertainty. One, whether the regulators will actually do that. Two, what actually constitutes a tough legacy transaction. And if you think about it from the regulators' perspective, they don't necessarily want to do this because they want to make sure that everybody still has the impetus to change and amend their transaction to the relevant risk-free rate. And then when you look at it, I also mentioned that, USD LIBOR, for instance. And so what the US have done similar under their process with the ARC, the lobby body with ARC, is that they've actually put in place some legislation to deal with this. But even still, that doesn't necessarily deal with all of the legacy transactions. And so what you end up with, and may actually end up with, is a mismatch between perhaps what the US is doing with what London, the UK, and the EMEA is doing, and also mismatch in terms of different types of products as well. And so it's a very, very complex issue here. And so I think that will be where the focus will be.
Wow. And you spoke just as before we came on the call about, your passion for getting new, refreshing ways of doing things within the legal industry and the role of technology. So, what is the role?
Yeah, that is my passion. My passion is to change the way that we're currently doing things, and I really, really am motivated to do that. And so the role of technology, and especially when we look at AI technology, is to look at how we can actually diligence our transactions and diligence our legacy transactions. And I think what financial institutions and firms as a whole are recognizing is that we don't actually know enough about the contracts that we sign. So we might know who we sign them with, what money we have to pay, but when you really get down to the nitty-gritty of the terms, and something like LIBOR will affect the terms of the contract, we really don't have enough data or information about the contracts. And that is where AI technology and fintech can help play a role in this transition, to help us diligence the contracts and help us build up a data source and a data warehouse of all of our contracts. And so that is, I see, the main role.
Fantastic. Well, look, it's really incredible getting your oversight of this. It's such a complex area, and interesting to hear the role of machine learning and artificial intelligence in this area. So for now, Stephanie, thanks so much for sharing that information with us.
Thank you, Richard. It was lovely to speak to you.